Welcome back to For Credit, guys. Today, we're diving into the world of asset-backed securities, or ABS. We'll explore what ABS are, the types of assets that can be securitized, and how these securities benefit investors. By the end of this video, you'll have a clear understanding of why ABS are a vital part of the financial markets and how they might fit into an investment strategy. Let's start with the basics. What exactly is an asset-backed security? An ABS is a type of financial instrument that is created by pooling together various types of loans or receivables, like auto loans, credit card debt, or student loans, and then selling this pool of assets as a security to investors. Essentially, it's a way for lenders to convert these loans into liquid assets that they can sell, thereby freeing up cash to issue more loans. But why would investors be interested in buying a pool of loans? The answer lies in the regular cash flows that these loans generate. When you buy an ABS, you are essentially purchasing the right to receive payments from the underlying loans. These payments typically come in the form of interest and principal repayments made by the borrowers. For investors, ABS can provide a steady income stream, often with attractive yields compared to other types of investments. Now, let's take a closer look at the types of assets that can be securitized into ABS. While there are many different types of loans that can be bundled into an ABS, some of the most common include auto loans. These are loans that consumers take out to purchase vehicles. When auto loans are pooled together and sold as an ABS, investors receive payments as borrowers make their car payments. Auto loan ABS are popular because they are generally considered lower risk. People tend to prioritize car payments to avoid losing their vehicles. Credit card receivables. This type of ABS is backed by the outstanding balances on credit cards. The payments that credit card holders make each month, whether they are paying down principal or just covering interest, flow through to the investors in the ABS. Credit card ABS can be more volatile due to the higher risk of default, but they can also offer higher returns. Student loans. These are loans issued to students to cover the cost of education. Student loan ABS are a significant part of the ABS market, especially in countries where higher education is widely financed through loans. These securities typically have long maturities, reflecting the long repayment periods of the underlying loans. Home equity loans. These are loans that homeowners take out against the equity in their homes. Home equity ABS became particularly popular during the housing boom of the early 2000s. However, they are also associated with higher risk, as seen during the financial crisis when many homeowners defaulted on their loans. Other receivables. Beyond these common types, virtually any form of receivable can be securitized, from equipment leases to royalty payments on intellectual property. The variety of assets that can be bundled into an ABS makes this a versatile financial product. So, how do ABS benefit investors? One of the primary advantages of investing in ABS is the potential for higher yields. Because ABS are backed by loans that may have higher interest rates, they can offer returns that are more attractive than those of traditional bonds or government securities. This makes them an appealing option for investors looking to enhance the yield of their fixed-income portfolios. Another benefit is diversification. ABS allow investors to gain exposure to different types of loans across various sectors. For example, an ABS backed by auto loans would behave differently from one backed by credit card receivables, allowing investors to spread their risk across different asset classes. Diversification is a key strategy in managing investment risk, and ABS can play an important role in a well-rounded portfolio. Liquidity is another advantage of ABS. Because these securities are traded on secondary markets, investors can buy and sell them relatively easily compared to the underlying loans themselves. This liquidity makes ABS a more flexible investment option than holding individual loans, which might be harder to sell. However, investing in ABS is not without risks. One of the primary risks is the potential for borrower default. If a significant number of borrowers in the loan pool default on their payments, it could reduce the cash flow to investors and, in some cases, lead to losses. To mitigate this risk, ABS are often structured with credit enhancements, mechanisms like over-collateralization, reserve accounts, or guarantees that help protect investors against losses. Another risk to consider is prepayment risk. This occurs when borrowers pay off their loans earlier than expected. While this might sound like a good thing, It can actually reduce the returns for investors because they will receive their principal back sooner and therefore have fewer opportunities to earn interest. Despite these risks, ABS remain a popular investment choice due to their potential for higher yields, diversification benefits, and liquidity. They offer a unique way for investors to gain exposure to different types of consumer and commercial loans, all packaged into a single security. Understanding the basics of ABS is essential for anyone looking to explore more sophisticated investment strategies or to deepen their knowledge of the financial markets. By including ABS in a diversified portfolio, investors can potentially enhance their returns while managing risk. If you found this overview of asset-backed securities helpful, make sure to give this video a thumbs up and subscribe to 4 Credit Guys for more insights into securitization and other financial topics. Let us know in the comments if you have any questions or if there's a specific aspect of ABS or securitization you'd like us to cover in a future video. Thanks for watching, and we'll see you next time.